The stock market continues to hit record highs. All the while, we still have much higher than normal unemployment numbers. Our US GDP is down. Small businesses are still suffering, and life just isn't quite back to normal. So if you're investing in the stock market, which if you've got a retirement account of some sort, you might be wondering, why is the stock market up when the economy is down? In this video, I'll walk you through the one simple reason for this disconnect that's going to help you better understand the relationship between the stock market and the economy. So stay tuned. Hey folks, Richard Walls here, and if it's the first time we're meeting, I'd like to welcome you to the channel. What the channel is all about is helping you with your professional branding, career development, and personal finance. So if you want to see more content like that, make sure to hit the subscribe button down below along with the notification bell so you get notified of when I post new content. And of course, if you like what you see, it'd be a huge favor to me and it would help the growth of my channel if you would also hit the like button down below as well. So with that said, let's get to it. So I laid out the context earlier of what's going on with the unemployment rate, which at the time of this video is at about 10.2% versus a recent historical average of just under 4%. Our GDP, which is broadly defined as the total economic output of our country, is down 31.7% in the second quarter of this year. But even with all that bad news, the stock market, by way of looking at the S&P 500, is continuing to see record highs. So here's the disconnect, and I'll explain it by talking about one fundamental concept in real-world stock valuations. The price of any given stock is really a reflection of what investors think the company is worth based on current and historical financial information. But also, and this is probably just as important, if not more important, is that the stock price is also based on what the investor thinks the company will be worth in the future. So there are various factors that go into it, but the bottom line is this. If you're an investor, you invest in a company whose stock price you think will go up in the future so you can sell in the future at a profit. And if you have the stock already, then you just hold on to it and wait for it to appreciate. Now, alternatively, you decide not to buy a stock if you think the price of the stock is going to go down in the future. And if you have the stock currently, you may decide to sell the stock if you anticipate the price will go down. Now that I've said that, here's a little bit of nuance. Investors have many ways in which they estimate the value of a company and come to some determination as to what they think the stock will be worth in the future. Now, you'll commonly hear, if you watch any kind of financial news network, you'll hear various investment firms and banks give price targets for certain stocks. And guess what? All these price targets can be all over the place. So who's right and who's wrong? Now, although all these positions may be well researched, ultimately, no one knows, and only time will tell, because quite frankly, there are a lot of variables. Now, one variable in particular is growth potential. And to illustrate this point, there are some companies out there that run these huge deficits year after year. They don't make enough money to cover that, and so they're running in the red, and they hold a lot of debt. Now, ordinarily, you might see these stocks as extremely risky, and they are. Now, we see this with a good handful of companies, but some notable ones are Amazon when they first started, now one of the most valuable companies in the world, and more recently, Tesla, who is also now one of the most valuable companies in the world. But the reason Tesla is priced where it's at is because although the company is still very risky, they don't bring in the same revenue as major competitors. They don't sell the same volume of cars as a Toyota or a Ford. They carry a ton of debt. Despite all that, investors believe that Tesla will be one of the most successful companies in the world. The revenues will grow, the profitability will also grow. They'll handle their debts, and because they are an innovative company, they'll maintain a technological advantage versus all other competitors, thereby solidifying their position in the marketplace. And more important than all of those is investors believe that you'll hit the like button at the bottom of this video. Not only does hitting the like button help with my channel, but it also helps with the market and the economy. So do it for the economy. So bottom line is investors are very optimistic about Tesla's future. They believe the stock price will be quite a bit higher in the future than it is today, which is why they're investing now, despite the current financial picture of Tesla. Now, what I just told you was specific to one company. Now, what we have to do now is take a step back and look at the stock market as a whole, which is made up of hundreds or thousands of public companies, depending on which index you're looking at. Now, most investment firms and banks have a very diversified portfolio, which means that they're invested in a lot of different segments and industries of the market. And because of the size of the firms, they tend to wield a lot of influence over the price of specific stocks and in the stock market as a whole, because anytime they buy and sell stocks, they're buying and selling millions of dollars worth of that company. Now, the reason that's important to know is because if the majority of investment firms were pessimistic about the future prospects of the market and the economy, well, then they'd be inclined to sell a lot of their stocks, sell a lot of their investments before everyone else does. They want to capture those profits before the value of their positions go down, because eventually other investment firms or other investors will sell their positions, driving the supply of that stock or multiple stocks up, and the demand isn't there to meet it, thereby driving the prices down. Now, that decline can sometimes happen very quickly and dramatically, as was the case earlier this year when the major news story broke out that the US government was going to basically shut down the economy, which caused a lot of investment firms and a lot of investors to sell their holdings because they expected, at least in the near future, potentially longer term future, that the value of all those stocks would go down. Now, obviously at that point in time, the stock market did crash and eventually hit a low point. And that was really reflective of simply a lot of uncertainty around the economy as a whole. But over time, you started seeing the economy, or the stock market rather, creep back up little by little, because investors at those price points realized that maybe the impact of this pandemic was overstated for certain companies and certain industries, and there's actually really good value here now at the price points that they're at. And based on where they're at currently, investors are optimistic about where those stock prices could be in the near future after the pandemic has been dealt with and we return to some kind of normalcy. Now, to tie this all together, although we do see some indicators that the economy is improving little by little, unemployment is still quite a bit higher than average, GDP is still down, and things aren't quite back to 100% normal. Despite all that, major institutional investors, investment firms, banks are still optimistic about the future, which is why they are buying into the stock market today, because they expect, of course, the prices of many of these stocks will go up in the future. So really, the stock market is being propped up by a lot of optimism. Now, I'll add a little bit of nuance yet again, which is there are certain industries that are performing better than others in the current climate, namely technology companies. So whenever you see the S&P 500 hitting record highs, it's usually on the back of those technology companies, because that's where major institutional investors are putting their money, and those stocks are dramatically outperforming any other stocks or any other industries that might be underperforming. So really, there is a net gain to the stock market as a whole. So I'll cap it all off with this. While I think it's a really good thing that institutional investors are optimistic about the future of the market and the economy, it's certainly no guarantee that the economy will resume back to 100% in the near future. And though it seems to be trending in that direction, a lot of things can happen. And in some cases, investors can be irrational as was the case in early 2000s with the dot-com bust. But again, there's a lot of indication that the economy is heading in the right direction, and the market will reflect that. It's reflecting the optimism now and will continue to reflect that in the future if it does indeed continue to trend in that direction. Folks, I hope that helps explain the situation a little bit better. I would love to hear what you think about the disconnect between the stock market and the economy, and if you think the economy will come back up to match what we're seeing in the stock market. Make sure to leave a comment down below and let me know what you think. So thank you for watching, and I'll see you around.